Recently, the White House announced that it wanted to move forward with an idea of bringing alternative investments into things like 401k retirement plans. One of the options could potentially be private equity. The question for many people is how would this play out, and is this a good idea? Burcu Esmer is a senior lecturer in finance and academic director of the Harris Family Alternative Investment Programs at Wharton, and she joins us to discuss all of this. Burcu, great to see you again. How are you?
Very good. It's great to see you then.
Thank you. What is it that's driving this idea of bringing alternative investments into traditional 401k and retirement plans?
hmm There are actually several forces behind it. One is when we look at public markets, they are representing a smaller share of the economy. So we have fewer companies that are going public and they're staying private longer. Just to give you some numbers, mid 1990s, there were around 8,000 public listed companies. Now it is short of 4,000. The median age at the initial public offering also doubled. So if investors, if we just focus on public markets, we are basically looking at more older companies, and we have fewer options to invest from. The other thing is of course, investors are becoming more and more educated about different investment opportunities. So people are hearing about private equity all the time, and they don't want to miss out. When we look at the returns, private equity has outperformed public markets 2 to 4%, depending on the timing and how you slice the data. 2 to 4% more than public investments. Of course, recent years, this softened a little bit. Uh, but at the same time, we look at pension funds. They've been investing in private equity for decades now. So why would individual retirement plan holders uh, miss that opportunity? So now policymakers are looking for ways to improve retirement returns as well, because people are living longer, they need more savings, they want a piece of private capital market, and private equity industry is also looking for new capital sources
Yeah.
uh, for many reasons.
That was that was going to be my next question, because it seems like when you think about the dynamics of the benefits laying out, obviously there's a potential for the investor, as you said, to be able to get into other areas that maybe traditionally they were not involved in. But for the private equity firm, potentially this opens the door to a lot more resources coming in than they've seen in the past.
Very well said. It can be mutually beneficial. There's no question the industry sees this as a new fundraising channel. When we look at fundraising, it was around $330 billion in 2024. We are looking at 401k plans with more than $12 trillion. So this is a great new flux of capital for private equity firms. Remember, I said when we look at private equity and the usual suspect, usual investors, they are the institutional investors, pension funds, endowments, sovereign wealth funds. Most of the institutional players, they already reach their allocation limits, so they cannot commit more capital to private equity. So for private equity firms, it is great, fresh, stable money for making investments.
When you think about the regulatory side of this, would there have to be limits put in place in terms of just how much people could invest in private equity? How would that work out?
Yes, I think limits are essential. Um, but before the limits, let's also talk a little bit about why regulations are important and why we're talking about this. So, plan sponsors, these are generally the employers, they have fiduciary responsibilities under the Employee Retirement Income Security Act, ERISA. So, what it means is if you are giving this option or this plan to the employees, you should give them a prudent menu of investment options. Okay, so most people, like everyone, I think we can all say that investments carry risk. So if there's an investment option in that pool with low return, or if you lose money because of that investment option, it's fair. But if these options are also coming with high fees, then it might be seen as imprudent, that which could expose the employer to lawsuits. So from the employer side, plan sponsors, it's really important to have the regulations. The private capital, it was not barred from 401k plans before. They tried, some of them tried, invest in private markets, but then there were some lawsuits related to this. The sponsors, employers, they don't want to be sued if they give that option. Why? Because there's almost like a parental duty for the employers to protect the people. So going back to your question, I think limits are essential. And I've been writing a piece on this, and my suggestion is 15% cap. So 15% of a diversified fund can be put in alternatives. Why 15%? It's not arbitrary. This aligns with SEC rule for illiquid holdings in mutual funds. So this way, there is some kind of a diversification benefits. You can put your money in alternatives, but at the same time, you are not compromising liquidity.
You mentioned the role that the company has to think about in terms of the level of investments. Part of this is also, and I think you've alluded to this in the past, is the fact that the investor in general is quite a bit more on top of their investments, of understanding the types of programs and investments that they're trying to make right now. So companies are dealing with, in many cases, a much more savvy investor than maybe, say, a couple of decades ago.
That's accurate. But I should also, we should be cautious about this as well, because alternatives, you can learn more about it with generative AI. You can also have access to amazing sources. That's great. But it's not just education. These are really complex investments. Knowing about them is not enough. And there is opaqueness that comes with it as well. So I think it's important for investors to know the risk of the investment, how it's not as liquid as a public equivalent investment option. And they should also know that there will be a lot of uncertainty about the value of portfolio companies in the alternative funds, in the private capital funds.
Are there other types of alternative investments you see as maybe also becoming part of the mix here as we move forward? Private equity, but others on top of that?
Private credit is another idea. It can be in the mix. So private credit is basically lending to companies outside the public bond markets, which has grown rapidly in the last couple of years. And especially in high interest rate environment, they can offer attractive yields as well. So there's that. There's the blockchain or Bitcoin, I should say, that is in the mix. Real estate is also in the mix.
Burcu, great to talk to you again. Thanks very much for your time today.
Thank you, Dan.
Thank you. Burcu Esmer, who is a senior lecturer in finance and academic director of the Harris Family Alternative Investments Program here at the Wharton School.